Hello and welcome to the September 30th, 2022 edition of Watching the Tape. This week's video is about the classic 60/40 stock bond portfolio. I stumbled across a great Bloomberg chart showing the historical returns of the stock and bond components of this model portfolio, and a few things stood out that I wanted to highlight. But first, let's go over a little background. What is the 60/40 portfolio? And in its most simple iteration, it is a portfolio consisting of 60% in the S&P 500 and 40% in US Treasuries. So 60% stocks, 40% bonds. And I look at it as a sort of baseline for constructing portfolios that make sense for individual investing clients. The 60% stock allocation is what is expected to provide capital growth for the client. And the 40% in bonds is what is expected to provide income and stability, as well as dry powder to reallocate to stocks if stock prices fall. So if you have a long time horizon and a tolerance for wildly fluctuating portfolio values, then you would dial up that 60% to maybe 80 or 90%, and vice versa. If you are in retirement and are currently drawing on your portfolio to sustain your lifestyle, then you would dial down that 60% to maybe a 40%. All right, so the version of the 60 portfolio that we're going to be taking a look at is 60% in the MSCI All Country World Index, which is an index that includes large and mid-cap companies across 23 developed countries and 24 emerging markets countries. And it includes about 85% of the total investable global equities universe. And I think of the global stock market weightings as, and it changes, it migrates over time, but 60% in the US, about 25% in developed international countries, and then the remaining 15% in emerging markets. So the 40% in bonds for what we're looking at today is in the Bloomberg Global Aggregate Bond Index, which includes mortgage-backed securities, government bonds, and corporates from all over the world in many different currencies. So this is more of a global 60/40 portfolio. So let's go to the chart. And I took this chart as far back as Bloomberg had data for both indices, which is 1991. So this includes 31 years plus the 2022 year-to-date period. The blue bars represent the equity component, and the orange bars represent the fixed income piece. So just by eyeballing this chart, you can clearly see how much more volatile the returns are for stocks than they are for bonds. And what I want to do now is focus on a handful of historical periods, and you can remember back to where you were when all this was going down. So let's start with the year 2000. So this is in the aftermath of the dot-com bust. It was not a pleasant time for stock markets. In fact, in 2000, global stocks fell 15%. 2001, they fell another 17%. And in 2002, they fell another 21%. But let's take a look at bonds. Bonds in 2000 were up 3%, up almost 2% in 2001, and then up 17% in 2002. So bonds certainly pushing the blow, which is kind of what you want from bonds. And in investment speak, we'd say that this is how diversifying into uncorrelated assets helps reduce portfolio risk. All right, let's fast forward to the global financial crisis of 2008. Global stocks fell 44%, but there was enough of a flight to quality in treasuries that bonds were up 5% that year. So again, bonds cushion the blow. Okay, now let's move to where we are today, year to date. Stocks are down 25% and bonds are down 20%. So bonds aren't doing their job. This is brutal. This is gut check time. So what are you supposed to do during times like this? Well, you're supposed to stay buckled in that roller coaster car that you're riding in, and you're not supposed to look at your portfolio values every day. Of course, we all know that. Come on, we're human, we're not robots. This is no fun. This is my profession, and it's still unsettling, but I'm nowhere near panic mode. And why is that? Well, for one, I'm 100% sure that I can't time markets. So there's no anxiety. I don't have any anxiety about what I should have done or what I should actively be doing right now. So that's one. And another source of comfort is when I look back historically over what to see what a diversified mix of stocks and bonds has done over the long term. And we're going to go back to the slides here. So what has happened over the long term? And long term, I mean 91 to the present, which is kind of the span of the chart we just looked at. And stocks have returned on an annual basis 7.3% over that time period, and bonds have returned 4.3% over that time period. So with all the big declines that we can see right here in this chart, it still made a lot of sense to stay invested, to grow wealth and outpace inflation over a longer stretch of time. So stomaching all that volatility has been worth it, and I think will continue to be worth it going forward. That's it for this week. We'll see you in 2 weeks.